Have you ever dreamed of predicting the stock market, buying low and selling high? Many investors have, but the reality is timing the market is a game you will almost always lose. In this video, I'll explain why trying to time the market is a waste of time, and if you stay till the end, I'll share with you a different strategy to successful investing. So let's dive in! We cannot predict when to buy or sell stocks based on market fluctuations, but just missing on a few days of positive gains can drastically reduce your investment's value. Fidelity has a really cool calculator on their website. It shows what happens to a $10,000 investment in the US market from 2004 to 2024 if you miss the 10, 20, 30, or 40 best days in the stock market. If you don't know Fidelity, it's the fund where the famous investor Peter Lynch used to work. There are roughly 7,300 days between 2004 and 2024. If you had stayed fully invested in the US market during that time, your $10,000 investment would have grown to about $85,000. Missing just the 10 best days out of 7,300 would cut your returns from $85,000 to $40,000, which is a $45,000 difference. If you miss the 20 best days out of 7,300, your returns drop from $85,000 to about $25,000, which is a $60,000 difference. Missing the 30 best days out of 7,300 would reduce your returns from $85,000 to about $15,000, which is a $70,000 difference. Missing the 40 best days out of 7,300 would drop your returns from $85,000 to about $10,000, which is a $75,000 difference. What key conclusion can you draw from this information? Trying to time the market can hurt your long-term performance because most of your returns come just from a few best days, which are only a small fraction of the total trading days between a long period of time. Based on this, what strategy should you consider? I believe that the best investment approach is to buy wonderful companies for less than their worth and hold on to them for a long period of time as long as they stay wonderful. A wonderful company is one you understand well, has a strong and lasting competitive advantage, and is led by a talented management team that acts with integrity. Warren Buffett, the best investor in the world, calls those companies compounding machines. It means those companies can steadily grow their profit and reinvest them in the business, which helps their value and their investors' money grow faster over time. When we look at his portfolio, the best example that comes to mind is his Coca-Cola stocks. He invested about $1 billion in Coke in 1988. Do you know how much he received in dividends from Coke in 2024? He received almost $750 million, which means he's getting back almost his entire initial investment each year. A dividend is a payment made by a company to its shareholders from its profits as a reward for owning a part of the company and investing their money in it. The yearly dividends that Buffett receives don't include the value of his Coca-Cola stocks, which are worth nearly $25 billion as of the end of June 2024. So just to summarize, the $1 billion investment made in Coke in 1988 is now worth almost $25 billion, plus he receives an annual dividend of nearly $750 million for owning those stocks. If you are still not convinced and want to learn more about why a long-term investing approach is key to your investing success, you will find in the description a video I recently made on that topic. This is it for today, guys. If you got value from this video, feel free to drop a like, and if you want to receive more content like this, feel free to subscribe. Thank you all, and peace out!